Hi friends, welcome to my channel. Today we are going to discuss on meaning and scope of accounting. So before we begin, let's first understand two of the most important terms in accounting, that is transaction and event. Tell me whether transaction and event is one and the same thing or are they different? If they are different, what is meant by transaction and what is event? So, transaction is used to mean a business performance of an act, an agreement, while event is used to mean a happening as a consequence of transaction or transactions, a result. Let's understand this better with an example. An individual invests $200,000 for running a stationery business. Then he purchased some goods for $115,000 and sold some goods for $147,000. He also paid rent of $5,000 and finds that he has a closing inventory of $15,000. So now I have told you about the few transactions, and the person has also encountered with some of the events. Is it not logical that he will want to know the result of his activity? So, the earning of the surplus, that is $42,000, is an event. Also, having the inventory in hand is another event, while the purchase and sale of goods, investment of money, and payment of rent are transactions. Everybody wants to keep a record of all the transactions and events to have adequate information about the economic activity as an aid to decision making. So, as the individual had recorded each and everything like the purchase of the goods, the sale of the goods, the paying of the rent, and the closing stock, he got to know the result of his activity, that is the surplus of $42,000. Now let's have a look on accounting. So what is actually meant by accounting? Accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. So let's break it down. It's an art. It records only financial transactions. Means if there are transaction in which no money or the no financial character is involved, it's not a part of accounting. The process of accounting starts by first identifying the events and the transactions which are of financial character and then be recorded in the books of account. For example, the individual running the stationery business would need to record all business transactions. This recording is done in journal or subsidiary books, also known as primary books. Every good record keeping system includes suitable classification of transactions and events as well as their summarization for ready reference. For example, the telecom company performing thousands of transactions on a daily basis is not expected to publish all those transactions for the users to make a decision. Surely, those needs to be summarized appropriately to draw a conclusion from it. Now let's see at the procedural aspects of accounting. First one is generating the financial information and the second one is the using the financial information. Now let's have a look at the various phases of generating the financial information. First one being the recording. This is the basic function of accounting. All business transactions of a financial character, as evidenced by documents such as sales bill, passbook, salary slip, etc., are recorded in the books of account. Recording is done in a book called journal. This book may further be divided into several subsidiary books according to the nature and size of the business. In our next videos, we will learn how to prepare journal and various subsidiary books. Next is classifying. Classification is concerned with the systematic analysis of the recorded data with a view to group financial transactions or entries of one nature at one place so as to put information in a compact and usable form. The book containing classified information is called ledger. This book contains on different pages individual account heads under which all financial transactions of similar nature are collected. For example, there may be separate account heads for salary, rent, printing, stationery, advertisement, etc. All expenses under these heads, after being recorded in the journal, will be classified under separate heads in the ledger. This will help in finding out the total expenditure incurred under each of the above heads. Now let's have a look at summarizing. Summarizing is concerned with the preparation and presentation of the classified data in a manner useful to the internal as well as the external users of financial statements. This process leads to the preparation of the financial statements. The term analysis means methodical classification of the data given in a financial statement. The figures given in the financial statements will not help anyone unless they are in simplified form. For example, all items relating to fixed assets are put at one place while all items relating to current assets are put at another place. It is concerned with the establishment of relationship between the items of profit and loss account and balance sheet. That is, it provides the basis for interpretation. Now let's look on the interpreting function of accounting. So it is the final function of accounting. It is concerned with explaining the data. The recorded financial data is analyzed and interpreted in a manner that will enable the end users to make a meaningful judgment about the financial condition and profitability of the business. The financial statement should explain not only what had happened but also why it had happened and what is likely to happen in specified conditions. So, what is communicating and what is it concerned to? So, communicating is concerned with the transmission of summarized, analyzed, and interpreted information to the end users to enable them to make rational decisions. This is done through preparation and distribution of accounting reports, which include, besides the usual profit and loss account and the balance sheet, additional information in the form of accounting ratios, graphs, diagrams, fund flow statements, etc. Now, let's have a look on the objectives of accounting. Basic objective of accounting is to systematically record the financial aspects of business transactions, that is bookkeeping. These recorded transactions are later on classified and summarized logically for the preparation of financial statements and for their analysis and interpretation. Now, accountant prepares profit and loss account to know the results of business operations for a particular period of time. If the revenue exceeds the expenses, then it is said that business is running profitably. But if expenses exceed revenue, then it can be said that business is running under loss. The profit and loss account helps the management and different stakeholders in taking rational decisions. For example, if business is not proved to be remunerative or profitable, the cause of such a state of affair can be investigated by the management for taking remedial steps. Now, a businessman is not only interested in knowing the results of the business in terms of profits or loss for a particular period, but is also anxious to know that what he owes, that is liability to the outsiders, and what he owns, that is assets, on a certain date. To know this, accountant prepares a financial position statement, popularly known as balance sheet. The balance sheet is a statement of assets and liabilities of a business at a particular point of time and helps in ascertaining the financial health of a business. Now, accounting as a language of business communicates the financial results of a enterprise to various stakeholders by means of financial statements. Accounting aims to meet the information needs of the decision makers and helps them in rational decision making. Now, by preparing the balance sheet, management not only reveals what is owned and owed by the business, but also it gives the information regarding concern's ability to meet its liabilities in the short run and also in the long run, as and when they fall due. That is the liquidity position and the solvency position of the business. Here is a snapshot of whatever we have discussed in our earlier slide. You can just pause here, take a screenshot of it, and keep it for your future reference. Now, let's have a look on the functions of accounting. First one is the measurement. So, accounting measures past performance of the business entity and depicts its current financial position. Accounting also helps in forecasting future performance and financial position of the enterprise using past data and analyzing trends. Accounting provides relevant information to the users of accounts to aid rational decision making. It also assesses performance achieved in relation to targets and discloses information regarding accounting policies and contingent liabilities, which play an important role in predicting, comparing, and evaluating the financial results. So, here I talked about contingent liability. Let me know in the comment section what is meant by contingent liabilities. Accounting also identifies the weaknesses of the operational system and provides feedback regarding effectiveness of measures adopted to check such weaknesses. Accounting as a function also provides necessary information to the government to exercise control on the entity as well as in collection of tax revenues. Now, let's understand what is bookkeeping. Bookkeeping is an activity concerned with the recording of financial data relating to business operations in a significant and orderly manner. It covers procedural aspects of accounting work and embraces record keeping function. Obviously, bookkeeping procedures are governed by the end product, that is, the financial statements. Now, let's have a look on the objectives of bookkeeping. First one is the complete recording of transactions, which is concerned with the complete and permanent record of all transactions in a systematic and logical manner to show its financial effect on the business. And secondly, the ascertainment of financial effect on the business, which is concerned with the combined effect of all the transactions made during the accounting period upon the financial position of the business as a whole. Now, let's have a look on the difference between the bookkeeping and accounting. Bookkeeping is basically concerned with recording of the transactions, while as accounting is concerned with summarizing of the processed recorded transactions. Bookkeeping, it constitutes as a base for accounting, whereas accounting is considered as the language of the business. Financial statements do not form a part of the bookkeeping, whereas financial statements are prepared in the process of in in this process on the basis of bookkeeping records. Managerial decisions cannot be taken with the help of bookkeeping records. Management takes decisions on the basis of accounting records. There is no subfield of bookkeeping, whereas accounting has various subfields like the financial accounting, management accounting, etc. The financial position of the business cannot be ascertained through bookkeeping records, whereas the financial position of the business is ascertained on the basis of accounting records. The relationship between the accounting and bookkeeping can be depicted in the following chart as shown below. So, bookkeeping is a part of accounting, which is a part of the accountancy. Now, let's have a look on the various subfields of accounting. First one being the financial accounting. Financial accounting covers the preparation and interpretation of financial statements and communication to the users of accounts. It is historical in nature as it records transactions which had already been occurred. The final step of financial accounting is the preparation of profit and loss account and the balance sheet. It primarily helps in determination of the net result for an accounting period and financial position as on the given date. Management accounting. It is concerned with internal reporting to the managers of a business unit to discharge the functions of stewardship, planning, control, and decision making. The management needs variety of information. The different ways of grouping information and preparing reports as desired by managers for discharging their functions are referred to as management accounting. A very important component of the management accounting is cost accounting, which deals with the cost ascertainment and cost control. Management accounting is concerned with the internal reporting basically. So now let's have a look at cost accounting. The process of accounting for cost, which begins with the recording of income and expenditure or the basis on which they are calculated, and ends with the preparation of periodical statements and reports for ascertaining and controlling costs. This is termed as cost accounting. Now, let's have a look on social responsibility accounting. The demand for social responsibility accounting stems from increasing social awareness about the undesirable byproducts of economic activities. As discussed, social responsibility is concerned with the accounting for social costs incurred by the enterprise and the social benefits created. And lastly, human resource accounting. It is an attempt to identify, quantify, and report investments made in human resources of an organization that are not presently accounted for under conventional accounting practice. Now, let's have a look on the users of accounting information. Generally, the users of accounts are classified into two categories: internal users and external users. Management accounting is concerned with identifying information requirement as well as methods of providing such information to management, while information requirements of the outside users are generally served by the financial statements. So, now let's have a look on the various users of financial accounting information. The investors. They provide risk capital to the business. They need information to assess whether to buy, hold, or sell their investment. Also, they are interested to know the ability of the business to survive, prosper, and to pay dividend. In non-corporate sector where ownership and management are not essentially separated, the owners still need information about performance of the business and its financial position to decide whether to continue or shut down. Next is the employees. The growth of the employees is directly related to the growth of the organization, and therefore they are interested to know the stability, continuity, and the growth of the enterprise and its ability to provide remuneration, retirement, and other benefits to enhance employment opportunities. Now, what information the lenders are interested? So they are basically interested to know whether their loan principal and the interest will be paid back when due. And as per our discussion earlier, the business judges its solvency position by its financial statements. The suppliers and the creditors are also interested to know about the ability of the enterprise to pay their dues. That helps them to decide the credit policy for the relevant concern, rates to be charged, and so on. Sometimes they also become interested in the long term continuation of the enterprise if their existence becomes dependent on the survival of that business. Customers are also concerned with the stability and profitability of the enterprise because their functioning is more or less dependent on the supply of goods. Suppose a company produces some chemicals used by the pharmaceutical companies and supplies chemicals on 3-month credit. If all of a sudden it faces some trouble and is unable to supply the chemical, the customers will also be in trouble. Government and their agencies, they regulate the functioning of business enterprises for public good, allocate scarce resources among competing enterprises, control prices, charge excise duties and taxes, and so they have continued interest in the business enterprise. The public at large is interested in the functioning of the enterprise because it may make a substantial contribution to the local economy in many ways, including the number of people employed and their patronage to local suppliers. Management as a whole is also interested in the accounts for the various managerial decisions. On the basis of accounts, management determines the effects of their various decisions on the functioning of the organization. This helps them to make further managerial decisions. Now, let's look at the limitations of accounting. The factors which may be relevant in assessing the worth of the enterprise don't find place in the accounts as they cannot be measured in terms of money. The balance sheet cannot reflect the value of certain factors like the loyalty and the skills of the personnel, which may be the most valuable asset of an enterprise these days. The balance sheet shows the position of the business on the day of its preparation and not on the future date. While the users of accounts are interested in knowing the position of the business in the near future and also in the long run and not for the past date. Accounting also ignores changes in some money factors like the inflation, etc. There are occasions when accounting principles conflict with each other. Certain accounting estimates depend on the sheer personal judgment of the accountant. Example, provision for doubtful debts, method of depreciation adopted, recording certain expenditure as revenue expenditure or capital expenditure, selection of method of valuation of inventories, and the list is quite long. Financial statements consider those assets which can be expressed in monetary terms, as we have discussed in the first point. Human resources, although the very important asset of the enterprise, are not shown in the balance sheet. There is no generally accepted formula for the valuation of human resources in money terms. Different accounting policies for the treatment of the same item adds to the probability of manipulations. Though through various laws and accounting standards, efforts are made to reduce these options to minimum, but certainly could not be reduced to one. In a nutshell, it can be said that the language of accounting has certain practical limitations, and therefore the financial statements should be interpreted carefully, keeping in mind all various factors influencing the picture. Finally, let's have a look on the areas of service. So, first one is the maintenance of the books of accounts. An accountant is able to maintain a systematic record of financial transactions in order to establish the net result of the transactions entered into during a period and to state the financial position of the concern at a particular date. The next area of service for the accountants is statutory audit. Every limited company is required to appoint a chartered accountant or a firm of chartered accountants as their auditor, who are statutorily required to report each year whether, in their opinion, the balance sheet shows a true and fair view of the state of the affairs on the balance sheet date, and the profit and loss account shows a true and fair view of the profit and loss for the year. Next is the internal audit. It is the management tool whereby an internal auditor thoroughly examines the accounting transactions, and also the system, according to which these have been recorded with a view to ensure the management that the accounts are being properly maintained and the system contains adequate safeguards to check any leakage of revenue or misappropriation of property or assets, and the operations have been carried out in conformity with the plans of management. An accountant can handle taxation matters of a business or a person, and he can represent that business or person before the tax authorities and settle the tax liability under the statute prevailing. He can also assist in avoiding or reducing tax burden by proper planning of tax affairs. Management accountant performs advisory function. He is largely responsible for internal reporting to the management for planning and controlling current operations, decision making on special matters, and for formulating long range plans. Many people need help and guidance in planning their personal financial affairs. An accountant who knows about finances, taxation, and family problems is well placed to give such advice. Accountants are also offering some other services like the secretarial work, the share registration work. They help in the company formation. They also act as liquidators in arbitrations and many more. So, to sum up, an accountant with his education, training, analytical mind, and experience is best qualified to provide multiple need based services to the ever growing society. The accountants of today can do full justice not only to the matters relating to taxation, costing, management accounting, financial layout, company legislation, and procedures, but they can delve deep into the fields relating to financial policies, budgetary policies, and even economic principles. Thank you for bearing with me till the end. I hope the video was helpful to all of you and it was quite a bit comprehensive video. Don't forget to like the video and share to the ones who are struggling with the accounting or they want to learn more about the accounting. Please subscribe my channel for more such videos.